The agenda topics for today's class lesson will be as follows. We will talk about the definition and features of managerial accounting. We'll talk about who primarily uses the features of managerial accounting, as well as the differentiation between product costs and period costs and how this impacts the overall manufacturing costs. We'll look at the computation of the cost of goods manufactured statement, and then follow up and end up with the preparation of financial statements for a manufacturing company. So strap in, get ready for another exciting world of accounting. Managerial accounting can be broadly defined as the practice of identifying, measuring, analyzing, interpreting, and communicating financial information to managers for the pursuit of a company's goals. The features of managerial accounting and the functions of management can be sort of outlined as follows. Managerial accounting by itself applies to all types of businesses. It applies to all forms of business organizations. It focuses more on the future and what should be. So we could say its goal is to provide information for management to make decisions. Also, for improving efficiency by comparing actual performance with targeted performance. Managerial accounting seeks to study the cause and effects between business activity and profitability. And lastly, it focuses upon or highlights the nature and characteristics of all costs. Those listed features begs the question, so who are the primary advisors or users of managerial accounting? Well, the answers to that question would be the executive officers, department heads, managers, supervisors, mostly inside personnel who are helping to run, if not actually running, the company. And since we are discussing management, let me outline the various management functions that intertwine with the goals of managerial accounting. They are 1. Planning. Planning requires managers to look ahead and to establish objectives. The second goal would be directing, and directing involves coordinating a company's diverse activities and human resources to produce a smooth running operation. And then lastly, controlling, which is the process of keeping the firm's activities on track. In order to more thoroughly understand managerial accounting, let me compare and contrast managerial and financial accounting. Here are the similarities. Both fields of accounting deal with the economic events of a business and require that the results of that company's economic events be quantified and communicated to interested parties. In contrast, here are the differences. 1. The primary users of reports. 2. Primary types and frequency of reports. 3. Purpose of reports. 4. Content of reports. And then 5, and finally, verification process. Managerial accounting and manufacturing costs are closely intertwined, as managerial accountants play a crucial role in tracking, analyzing, and controlling the costs associated with manufacturing processes. The relationship between managerial accounting and manufacturing costs is essential for the effective decision-making and strategic planning within an organization. In summary, the relationship between managerial accounting and manufacturing costs is integral to effective cost management, decision-making, and overall organizational success. Managerial accountants work with manufacturing costs to provide valuable insights that guide strategic and operational decisions within a company. Manufacturing costs typically are classified as the following. 1, and I call this the big three. Number 1 is direct materials. raw materials that can be physically and directly associated with the finished product during the manufacturing process are called direct materials. Direct labor. This is the work of factory employees that can be physically and directly associated with converting raw materials into finished goods, which is then considered direct labor. And then thirdly, manufacturing overhead. Manufacturing overhead consists of costs that are indirectly associated with the manufacture of the finished product. At this point in the lecture, a discussion regarding product versus period costs is necessary. Product costs are costs that are necessary and integral part of producing the finished product. Product costs are also called inventoriable costs. These costs do not become expenses until the company sells the finished goods inventory. On the other hand, period costs are those costs that are identified with a specific time period rather than with a saleable product. These costs relate to non-manufacturing costs and therefore are not what we call inventoriable costs. Let's now discuss the preparation of financial statements for a manufacturer. We first begin to construct the cost of goods manufactured schedule. Constructing a cost of goods manufactured schedule involves summarizing the cost incurred during the manufacturing process to determine the total cost of goods produced. This is done when companies add the cost of the beginning work in process to the total manufacturing cost for the current year to arrive at the total cost of work in process for the entire year. They then subtract the ending work in process from the total cost of work in process to arrive at the cost of goods manufactured. Let's walk through the steps to create a cost of manufacture schedule, and we can very well understand how it works. The first step is to determine and locate the amount for the beginning work in process inventory account and list it on the schedule. The next step, step 2, is to identify direct materials costs or direct materials used. This is done by listing the beginning inventory of raw materials, then adding the purchase of raw materials during the period, which will represent all materials that are available. Next, you will subtract the ending inventory of raw materials from the total of raw materials beginning balance and the purchases of raw materials to determine the direct materials used in production. Now we're ready for step number 3, where we will calculate direct labor costs. This is done by summing up the direct labor costs incurred during the period. In step 4, we determine manufacturing overhead costs. In this step, we will identify and calculate all manufacturing overhead costs, which include direct materials, indirect labor, and other manufacturing related costs. We are now ready to compute total manufacturing costs. This will be accomplished by adding the direct materials used amount, direct labor costs, and manufacturing overhead costs to find the total manufacturing costs. We are almost home and ready to complete the cost of goods manufactured schedule. So our next steps are to add the beginning work in process inventory to the total manufacturing costs to determine the total cost of work in process. Next, we subtract the ending work in process inventory to find the cost of goods manufactured. Once that is done, we will have completed the prepared cost of goods manufactured schedule. Be sure to use the format shown on your screen, as this will ensure you have organized the information in the proper format. We have now completed our construction of the cost of goods manufacturer's schedule, which is listed on the screen. We are now ready to construct the next statement, and that is the cost of goods sold statement. To begin this process, we will first list the beginning finished goods inventory amount on the cost of goods sold statement. In our next step, we will use the total cost of goods manufactured amount that we previously computed on the cost of goods manufactured schedule and record that amount on the cost of goods sold statement. Now, in step 3, we will add beginning finished goods inventory to cost of goods manufactured, and the total of these two items will produce the cost of goods available for sale amount. When using this amount, we will then go to step 4 and deduct the ending balance of the finished goods inventory amount from the cost of goods available for sale amount. And the result will be the amount for cost of goods sold. So in the final step, the cost of goods sold amount will then be transferred and listed on the income statement. And here is the income statement, which you should be familiar with at this particular stage. Now, for those of you who may be scratching your head and wondering, so what is the difference between a cost of goods sold section or statement for a merchandising company like a Walmart or Best Buy electronics store company compared to a manufacturing company like Ford or Honda car makers? Well, the difference between a merchandising and a manufacturing income statement is what we call the cost of goods sold section. Remember, the cost of goods sold statement is a crucial component of the income statement that helps to determine the cost of producing or purchasing goods that a company sells during a specific period. The structure of the cost of goods sold statement can vary between a merchandising company and a manufacturing company. For a merchandising company, you have to consider the nature of the business. Specifically, the merchandising companies primarily buy finished goods from suppliers and sell them directly to customers without undergoing any further production process. As a result, the cost of goods sold statement will include the following components. Number 1, beginning inventory. This is the value of the inventory from the previous accounting period that hasn't been sold. Number 2 are net purchases. This represents the total value of goods purchased during the period. Third, we have ending inventory. This is the value of the remaining inventory at the end of the accounting period. The formula for a merchandising company's cost of goods sold formula is as follows. We take cost of goods sold, which is equal to the beginning inventory plus net purchases minus ending inventory. Now, in contrast, a manufacturing cost of goods sold section shows beginning and ending finished goods inventories and the cost of goods manufactured. More specifically, manufacturing companies produce goods by transforming raw materials into finished products. As a result, the cost of goods sold statement of a manufacturing company will include these particular components. 1, beginning finished goods inventory, which is the value of completed goods from the previous accounting period. 2, cost of goods manufactured, that represents the total cost incurred to manufacture products from the beginning and transfer them into finished goods inventory for retail sale. And then third, ending finished goods inventory, which is defined as the value of completed goods at the end of the accounting period. The formula for a manufacturing company's cost of goods sold is as follows. Cost of goods sold equals beginning finished goods inventory plus cost of goods manufactured, which together will equal cost of goods available. Using the cost of goods available, you will subtract ending finished goods inventory, and the result will equal cost of goods sold for a manufacturing company. So in summary, the income statements of a merchandising company and a manufacturing company only differ when it comes to the cost of goods sold section. To move to the next stage, and that's the preparation of financial statements for a manufacturer. In other words, a manufacturing balance sheet or a balance sheet of a manufacturing company. The difference between a merchandising and a manufacturing balance sheet is in the current assets section. The current assets section of a manufacturing company's balance sheet presents three inventory accounts: finished goods inventory, work in process inventory, and raw materials inventory. The manufacturing inventories are reported in the current assets section of the balance sheet. 1. Inventories are generally listed in the order of their expected realization in cash. And 2. Finished goods inventory is listed first. At this point, I think it's time that we are ready to walk through a practice problem to illustrate how the managerial accounting concept works when applied in real-life situations. So, okay, I have a problem before us, and the problem states Superior Company has the following costs and expense data for the year ending December 31st, 2017. And the instructions are to prepare a cost of goods manufactured schedule, an income statement, and a partial balance sheet. In order to fulfill these instructions, the following additional information is provided: raw materials inventory, both the beginning and ending balances; indirect materials; work in process, both beginning and ending balance; finished goods inventory, both the beginning and ending balance; direct labor; various expenses, revenue, indirect labor, etc. So now we will go on to the next screen and construct the various schedules and statements as required by the practice problem. Take a minute just to look through the problem and then move to the next screen. So we're ready to take a look at the instructions, and we'll look at them and see that we're seeing that for Part A, it requires for us to prepare a cost of goods manufactured schedule for Superior Company for 2017. This should look familiar because I've used this same schedule to explain the components of the cost of goods manufactured schedule in previous slides. So as we begin to construct a cost of goods manufactured schedule, we will need the amounts for the following accounts. Those accounts would be work in process, both the beginning and ending balance; raw materials inventory, both beginning and ending balance; the raw materials purchases; direct labor; and manufactured overhead, which is further broken down into any of these individual accounts. And that is, indirect labor is a form of manufacturing overhead. Now, our first step is to determine and locate the amount for the beginning work in process inventory account and list it on the schedule. In this problem, that amount is $24,200. The next step, step number 2, is to identify direct materials used. This is done by listing the beginning inventory of raw materials in the amount of $17,500, then adding the purchases of raw materials in the amount of $168,400, which occurred during the period, which will represent all raw materials available in the amount of $185,900. Next, you will subtract the ending inventory of raw materials, which amounts to $23,900, from the total of raw materials beginning balance and the purchases of raw materials to determine the direct materials used in production. This will total out to $162,000. Basically, we're going to take the $185,900 and subtract the $23,900 to come up with $162,000. We're now ready to move into calculating direct labor costs, and we see that that amount is $181,000. This is done by summing up the direct labor costs incurred during the period. In our next step, step 4, we're going to determine the manufacturing overhead costs. In this step, we will identify and calculate all manufacturing overhead costs, which include indirect materials, indirect labor, and other manufacturing related costs. In our problem, the total amount of manufacturing overhead costs is $59,500. We are now ready to compute total manufacturing costs. This will be accomplished by adding the direct materials used amount, direct labor costs, and manufacturing overhead costs to find the total manufacturing costs, which equals $402,500. Now, we're almost home and ready to complete the cost of goods manufactured schedule. So our next steps are to add the beginning work in process inventory amount of $24,900 to the total manufacturing cost of $402,500 to determine the total cost of work in process amount of $426,700. Next, we subtract the ending work in process inventory amount of $26,700 to find the cost of goods manufactured amount, which equals $400,000. Once that is done, we have completed and prepared the cost of goods manufactured schedule. Be sure to use this format shown on your screen, as this will ensure you have organized the information in the proper format. Any repairs, utilities, and expenses related directly to the factory are not just general costs. Various expenses, revenue, indirect labor, etc. are other incidentals we have to take into consideration when we start our income statement. In the next portion of the instructions, we are required to prepare an income statement for Superior Company for 2017. In order to do this, we will use the total cost of goods manufactured amount that we previously computed on the cost of goods manufactured schedule and record that amount on the cost of goods sold statement. I want to start by directing you to the cost of goods sold section. Here we start with the beginning finished goods inventory balance in the amount of $110,000 and add that to the cost of goods manufactured amount of $884,000. And the total of these two items will produce the cost of goods available for sale, which amount to $994,000. Next, we deduct the ending balance of the finished goods inventory amount of $120,000 from the cost of goods available for sale amount of $994,000, and the result will be the $874,000 amount for cost of goods sold. Now, in the final step, we subtract the cost of goods sold amount of $874,000 that was just calculated from sales revenue of $1,500,000, which will give us a gross profit of $626,000, total. Now, we haven't quite finished, so let me go on. Our next to final step is to calculate the total operating expenses, which adds up to $550,000, and then we will deduct this $550,000 from the $626,000 of gross profit amount. Once that is done, we will show a net income of $76,000. And here is the income statement, which you all should be familiar with at this stage of your accounting curriculum. This concludes the module on managerial accounting. You should now read your textbook to provide more in-depth understanding. If you have any questions, comments, points of discussion, or there is something you just don't understand, please bring it to my attention at the next class. This helps me to help you to continue being an excellent student. I look forward to seeing every one of you in our next class.